and welcome to Freightonomics, May 2nd.
It's May already.
May already. Zach Strickland, head of Freight Market Intelligence. Tony Mulvey, head of Something Research, here with you on this Thursday in May. And warmer temperatures, spring has sprung in most of the country. I haven't seen any produce movements that are significant yet, although we did see a little bit out of Florida.
You're seeing Lakeland
Mother's Day.
That's true. Lakeland starting to move up. I mean, rejection rate's one of the highest jumps in the reefer side in quite some time. I saw it I guess yesterday. So
I think the reefer market is poised for a nice springboard here. All it's going to take is a gust of wind.
And that's what's needed. I mean, the holiday, Mother's Day, flowers, things like that, produce can't get here soon enough.
For those refrigerated carriers.
But I mean,
it is interesting.
I think what's interesting to me, and Zach, you'll touch on it here in a second, want to hear your takes on it, but I mean, you're still seeing that rejection rate's getting awfully close to where it was a year ago. We talked about seeing it slightly above. It is right at it. So, Zach, I mean, kind of break down where we're at in this market in two, and I'll count you in.
All right, let's do it. Right to the point. I like
3, 2, and 1.
All right. Tender rejection, O-try. It includes refrigerated, although it's roughly 20% of the overall index volume. You see rejection rates crawling across this floor around 3%, just above 3%, I should say. Doesn't matter. The difference between 3.5% and 3% is almost nothing, imperceptible to most people in the space. There's no trend shift here. That's what I'm looking for. I don't expect it at the end of April. I certainly really don't expect it in the beginning of May. But I do start to expect this thing to creep higher around the middle of May. So maybe give it 2 weeks, closer to Memorial Day. We'll know a little bit more about this market overall. We are still in a situation of abundant capacity, supply, all three modes or equipment types included in this: flat, refrigerated, and van, all showing suppressed behavior. Flatbed being the most volatile right now because, well, largely it's that time of year. Let's go to the next one. Outbound tender volume index, demand, relatively flat. One of the reasons we see the tender rejection rate come down, however, though, is the growth in the local or less than 100-mile freight volume, which is accepted at a higher level. So you see about a 98.5% acceptance rate for the local freight. We saw an increase. We've been seeing increasing volumes there. That's what's really driving a lot of the rejection rate down currently. If we go to the next chart, that will illustrate this. You'll see that one line that's shooting above all the others is the local freight, less than 100-mile load volumes there. It shot up there at the end of the month of April, had a lot of local freight moving, probably some projects going on. That has kind of come down, but it's still, the overall trend line is up. And long haul and short haul are dominating the freight market volume growth line right now. And short haul is a much larger component. If we go to the last chart here, I talked about flatbed. This is the spot rate indices for flatbed in white, refrigerated in blue, and then van down there on the bottom. Flatbed showing a little bit more of a nudge higher, much less served market, therefore a lot more volatile as well.
Yeah, and Zach, I think I look at the flatbed and I think we're in May, construction projects starting, warmer temperatures across the country, more project freight. Guess what? It leads to higher activity in the flatbed market. Hard to see volume because a lot of it is project freight, right? It's not tender contract.
Yeah, you don't have flatbed like operators just laying around like you do with van. I mean, they did not get the COVID service in terms of capacity expansion that refrigerated and dry van did.
Yeah, it's challenging freight, right? I mean, you have to think about straps, tarps, all the things that the flatbed driver has to deal with versus, I don't want to call them the run-of-the-mill dry van, general freight carrier that, I mean, they are still responsible for the freight, but it's much less challenge. The challenges for them are different in the two.
Yeah, well, you don't have a lot of fungibility of van and refrigerated drivers going into flatbed.
Yeah.
You do have a lot of fungibility of flatbed drivers going into refrigerated and van.
Yeah.
Because the van or the flatbed side, of course, requires a lot more labor and manual work, and you're going to places that a lot of people just don't want to go.
Yeah, you see deadhead percentages a lot higher in flatbed carriers because, I mean, if you have to go deliver something from Dallas out into the oil fields in Oklahoma, like, odds of you getting a backhaul out of somewhere in the middle of oil fields is good luck.
Yeah,
right?
job sites. So not a lot of docks, a lot of extra work there, and a lot of nuance in the flatbed space. So it's easy to kind of push those higher, especially this time of year. Although I will say that, look at van. If you're ever concerned about how sustainable is a market, look at the van side first. The van rates are still crawling across the floor. That means that any spikes in either refrigerated or flatbed, they're going to be pulled towards the van side of things in some form or fashion. We do expect flatbed rates to always be higher for all the things we just talked about, though.
Yep, absolutely.
Well, let's go on into the economics section of this. So, we were talking about GDP coming in at 1.6% last time, and I think this is a decent call out to have that Bo King actually made this mention in one of our calls, and the IOTI kind of showed a huge spike. Now, we're going to talk about this index in two spots today because I think it's relevant for the macroeconomics. The IOTI, of course, we can go ahead and pull it up, is the inbound ocean TEUs index of container volumes coming across the ocean into the United States. So it's imports, containerized imports, moving across the water into the United States. Huge spike here in the first quarter. Lunar New Year. It outperformed the Lunar New Year periods in each of the COVID years. So this to me, and the point being with GDP, imports
drag GDP lower.
Yep. And this could be something, as we can see here, that is washed out because we haven't had the number of exports to kind of overcome that.
Correct. Yeah, and part of that's been the manufacturing slowdown. I mean, I look, not to pick on Boeing, but going there. I mean, Boeing's one of the largest exporters of moving, because in GDP, imports and exports are based on volume or value in dollars, right? So high value goods have a bigger impact. So when you export airplanes that are hundreds of millions of dollars, that has a boost. When a company like Boeing has issues that they've had, and it's no new news, right? It's been well documented. It basically creates this deficit. It widens this deficit when you can't export high value items that the U.S. is known for exporting, or you import a lot lower value items, but at much faster or higher rates of like speed through the system.
So I think the takeaway here for anybody that's transporting goods or interested in macroeconomics, don't read too much into this.
Yeah, look at the import number because that's the part that actually moves freight, not the actual GDP number doesn't.
Exactly. And this was a lot of pull forward, like an extreme amount of pull forward, which actually supports growth in later quarters for domestic transportation. Now, the second thing I want to talk about, consumer confidence. You brought this up.
It's sliding.
Wow. And again, I've talked about consumer confidence not being something I really care about because it's feelings, but I think there are some takeaways here, but tell me your read.
Well, my read, one, it's low. And again, it is feelings. Consumers can feel one thing and do something different. They do it all the time. But I think where you're in a situation where consumers are starting, and it's starting to show up in company earnings, and you start looking at companies like McDonald's, highlighting consumers are starting to pull back and being more discretionary with their spending and where they're spending. So look at Starbucks. North America and U.S. comparable sales down 3% year over year. That is a slowdown. It was a 7% decline in actual transactions. So they were able to offset it with higher prices to some degree, but you're seeing transactions start to slow down. And there's actually another chart I think is very interesting in this. And we'll pull it up. It's over the next 6 months. Where are consumers going to pull back? Eating out, that discretionary spending on eating out. And some of this is, I think the other one's clothing that's really high. So more, you're seeing pullbacks in some services or expected pullbacks and where
these are non-durable goods, by the way.
And non-durable goods, right? So like to me, this highlights that there are expectations of, hey, we're going to slow down some of our spending on these non-discretionary items.
Yeah. So, I mean, food away from home, food away from home, clothing, entertainment, vacations, top 4. Most of that, now there is a little bit of a refrigerated component of that food away from home thing. Most of that, not durable. Clothing does move some freight, but it's, not really a huge component of what we see. And then the fifth one, groceries.
That one's interesting.
This is one. So, so food takes two of the top five.
Yep.
And we're seeing a refrigerated market that is pretty suppressed.
Yes.
And I'm wondering if that has anything to do with the other.
I think it probably does. I think the interesting thing to me, this somewhat highlights to me that those you're going to see changes in shopping behaviors more than anything, trading down, things like that. A lot of the earnings calls that I've looked at from like grocery and retailers is like consumers are searching for value, but we're not really seeing a huge trade down. I think that's going to be this next step in like, where do we go from here? Is if that really starts to take hold. I mean, you start looking at inflation numbers, right?
Yep.
And they're still hotter than expected. I mean, I've noticed food away from home prices, especially
crazy.
here. I went to Cookout on Monday night. Notorious, when I was in college, it was $5 for a Cookout tray. It was $4.99. I looked this week, it was $7.69 for the same thing. So, I mean, you're talking a pretty big increase in these food prices.
And we're in Tennessee.
Yeah. So, I mean, like these are the adjustments that you're going to start seeing people make changes. Then you add in California, adding their $20 an hour fast food wages. Guess what? That comes from somewhere.
Yep.
Business owners aren't just going to eat that cost and be like, oh, well, means the prices are going to go up at these places, which means people will have to decide if they want to spend the money there or spend it somewhere else.
It's an inflationary mechanism.
Yes.
And you can't run away from it.
Yeah. I mean, I think that's the challenge is like you're getting from a government side, you're starting to enforce things that cause inflation, at least on the local and state level.
Well, California is it's the GDP of a small country.
Yes, it is.
So it has everything that happens there has a huge influence over what happens in the rest of the country.
Yeah. And I think though, when you start looking at it, it's going to have an inflationary impact to the consumer.
Yep.
So while wages are increasing, other things are going to be increasing. Prices are going to be increasing too, because again, it's not going to be those costs associated with rising labor costs aren't just going to be eaten.
No, right.
So,
and I agree. And again, it's interesting to see how this plays out, especially with consumer demand. They've been resilient through a period where we didn't think that they were going to be that resilient, especially third, fourth quarter last year.
Yeah.
The student debt stuff didn't really, it caught us off guard. It really didn't do anything. Everybody just threw a bunch more money on their credit card.
Yeah. And the student debt thing, I think it's still early innings because I think there's a lagging effect. It's like we can throw things on our credit cards until they break, but
there's always that question of how fast does these manifest?
That we're still only 7 months, 8 months from that resumption. Like it's not breaking yet, but I mean you're starting. And I think the concern for me is if you look at delinquencies, still historically low, but the trend line is moving higher very quickly on credit cards. And I think that's one area to kind of pay attention to. Like it's going to take time for that to manifest itself to whatever it does. But the trend line that it is on, I would argue, is more concerning than the actual level.
For sure.
If that continues, you will be in a very different economic state very quickly, and you won't realize it until it's broken. I think that's part of it.
And I think you're exactly right. I think this situation where we see the economy kind of overachieving, like we thought the economy was kind of underachieving for a minute, and then all of a sudden, it blew up. So I think these sentiments are valuable in the way that it's giving us kind of a forward look.
Well, they've never called a recession early, right? It's always backward looking. You're looking at what's happened in the past. So it's like you got to figure out some gauge of where things are now because hindsight's always 20/20. It's easy to call a recession after it's already happened or when you're in the midst of it, like in the depths. It's really hard to time these things out in the early innings.
Yeah, and of course,
not saying that we're in a recession.
We're going to be watching the jobs report this week. It's expected to have $240,000 jobs added in April, 3.8% unemployment, which is historically low, but we've talked about this in the past. That is not a number to really look at from a historical perspective at this point. There are lots of cracks in that armor. I don't think that there's really anything that makes me think that we're going into a concerning period. But we should be mindful that maybe things aren't as great as we thought they were, especially if you're in freight. From a demand side, there's still a lot of questions around the forward-looking demand curves.
I mean, at the end of the day, on the freight side, it's still all capacity driven, and that's going to be, at least in this instance, it's that way. It's not been demand driven, but hey, at least put on some like, hey, let's keep an eye on this over the next 6 months, because things can change rather quickly.
And of course, the Fed coming out saying that there's no increases likely coming in the next bit. So that's, I would say, positive news for most.
Yeah, I don't think that one's unexpected, though.
Right.
They weren't going to go higher. Now, they say that, and then if inflation comes in hotter than expected for the next 2-3 months, they may change their tune. Everybody's expecting them to change, was expecting rate cuts, really starting to.
Things change so fast
the
nowadays.
First one.
Yeah.
Where it was first expected. Now you're looking at possibly one rate cut is now what's being priced in by the market. Not coming till November.
Information all over the place makes things change so rapidly. You cannot take your eye off the ball for too long. You will miss the turn. Speaking of not missing the turn, let's go into our first news of the day. C.H. Robinson stock blasts higher after some strong first quarter numbers. Now, to me, these earnings expectations, hits and misses, are kind of, fool's gold to an extent, in the way that, okay, so things weren't as bad as we thought they were going to be from the financial standpoint. This is, John Kingston writes this article, and he mentions that C.H. Robinson is reportedly one of the most shorted stocks in the market. So that, of course, puts a ton of downward pressure on the rate in general. And then you get these quick upticks when they outperform any kind of expectation, when there's any kind of positive.
Short covering.
Yeah. So it's kind of like, okay, let's hold tight here. Let's look at the stock price over the last 5 years. I pulled this morning, so it's already out of date from the stock market perspective. But you can see this curve here over the last 5 years. It largely looks like an OTVI to me. And with OTVI being what it is, down there, it's a little bit more flat here in recent months. Demand has come up. It's not a one-to-one correlation, but you see the freight market is still relatively soft. This was still the second worst EPS in several years, tied with third quarter of last year.
Yeah.
So it's not like everything's all better.
No, I mean, you still saw significant revenue declines. You saw gross profit declines. I mean, you're still seeing declines. It's expected in this market. I think the surprise, I mean, I will give them all the credit in the world. Their cost-cutting measures that they have implemented are starting to work, and they're showing up, even though you're still seeing declines.
Well, we talked about it before.
Year over year.
They laid off 12.6% of their North American surface transportation division.
They did, and saw margins expand in the quarter, 50 basis points sequentially, which is, when you see revenues decline 9% year over year, basically flat quarter over quarter, and you see margin expansion, you see adjusted gross profit start to increase there, just means that they were really good at controlling costs from a personnel side.
Yeah, because they didn't, but I will give them some credit for revenue being flat. I think that's actually a positive sign. Any kind of moment in transportation where first quarter outperforms fourth quarter, that is a thing. Like there's no discount there. Now, they largely did it through a traditional cost-cutting maneuver, especially for brokerage side, but their forwarding volume was up 7%. If we can pull up the IOTI one more time. The IOTI, of course, the import volume, container volume, forwarding volume up 7%. Look at that big spike, Tony.
I mean,
is this a shocker?
No, not at all. And then you saw revenues up 8.7% in forwarding, right? But
I mean, and that's off of the fourth quarter import volume, which if you look at the fourth quarter volume, the second half of the year really kind of fell off with imports starting in, October was disappointing because of Golden Week, but it never really recovered. If you're looking at the previous year, I know it's a little noisy, but first quarter this year for maritime shipping
wasn't bad.
And you had the Red Sea stuff on top of that.
Well, that was the other thing they cited. They said higher pricing. Well, that led to higher pricing, right? So,
because of all the stories. We have rates, of course, that were outperforming the previous quarter, no problem.
Yeah. So all these things to say, like the quarter as a whole was good. I mean, even despite revenue declines, that was expected. They've done things to set themselves up to be. I mean, you look at truckload volume down 0.5% year over year. It's not too bad compared to some of the other providers that we've looked at. You see LTL volume actually up 3%. Some of that, I would assume, is yellow freight that's still working its way through the system that they had to go to someone. But, I mean, as a whole, total NAST volume was up 1.5%, which tells me their LTL space or segment of their business has grown. It's either getting bigger or it's punching above its weight. I mean, and on the truckload side, like they're moving things right in line with where the market is. Their average rate to that their customer pays them was down 7.5%. It's kind of right in line with where van contract rates are. The cost that they were paying their carriers, so the spot rate, down 7.5%. So I mean, like they didn't see really any gains from that perspective, right? They weren't able to push the rate to the carrier down faster than the rate declined, but it didn't matter because they had cut 13%, right? So like
a lot of overhead.
Yeah, exactly. So you cut your that low-hanging fruit to some degree, the bottom 10.
Well, that's how you control costs in a brokerage.
Yeah,
and
it's really the only way.
Yeah, that's it. Technology and overhead.
Well, and we can talk about technology spend and what they've done over the past 5 years. But I mean, overall, solid quarter in a period that was. I was expecting it to be worse than what it was.
I think all of us were, especially considering every other brokerage saw a sequential decline that we've seen thus far. It's still a challenging market for brokerages. It's still one of the worst ones we've ever seen historically. For them to actually turn a corner, regardless of their methodology, that is a relatively positive thing. I don't know that I'm expecting any sustainable momentum here until the market recovers itself.
Yeah, the question is going to be, do they go back to the same old problems that kind of caused margin? But they're going to face margin kind of compression again when the market turns, happens because spot rates move faster than contract rates. Do they go and hire a bunch of people again?
Yeah.
And basically just wipe out everything they just did, right? Like that's going to be the ultimate question moving forward is, did you learn from this or do you go make the same mistake again and have to deal with this again when the market...
The question is, are they going to be flexible enough to flex up when the market turns the other direction? Now, C.H. Robinson, we looked at the chart before this show. If you look at their margins over the last 10 years...
They've been compressing.
They're compressing in trend, but they make their biggest margin expansions occur from a tight to a loose environment. 2016, 2019, 2020 or 2018 into 2019. That's the best brokerage environment for margin expansion because information is largely not known about the market tightening.
And you're seeing those peaks come down, which as more information becomes available, it challenges margin because carriers are understanding what's happening in the market. They don't want to push the rates. The customers, so shippers are understanding what's happening in the market. They're looking for rate reductions rather quickly. It pushes this downward, just total trend lower. And I think that's what you've seen.
Yeah. I want to talk about, a trend that I think is important to monitor. Mexico, of course, becoming one of the biggest, trade. Well, it already is the biggest trade lane between the United States, but it is by value. But it's, we're seeing these drivers being hired in Mexico, and they're getting Mexican wages, but they're getting elevated Mexican wages, and they're coming to the United States and they're driving. Now, I don't know how prevalent this is, but it's certainly going to be something to monitor around those border towns, or especially in Texas, where freight volumes are growing. This is going to suppress wages for the United States, but it's going to also pull drivers out of Mexico.
Yeah, I think for this one, the big key is that this is still, like, as Mexico and nearshoring things become more impactful or more I shouldn't say impactful, it's probably not the best word, but like grows as a whole, as we try to, I don't say disassociate ourselves with China, but I mean, to some degree we are. We're slowing that, growing in Mexico, that trade. You're going to see it might become more prevalent as a whole.
Yep.
And the question is going to be, then's when real concerns start happening, right? Like that's how safe, what are the safety standards?
Yep.
And how do those change too, right? Like
all sorts of stuff here. But it definitely one to monitor. Now we've got, if you want to hear more about this, of course, we've got a future of supply chain coming up in June.
Got to use code Freightonomics FSC24. Get your discount, get your ticket now. We'll be doing this twice at the show.
Yeah. You'll get to see us live. Come ask us a question.
Yeah.
Specifically about C.H. Robinson.
Yeah.
No, or whatever you want to talk about. Have a great week.